Right, it is 6:30. We are going to be kicking this meeting off. Peter's going to be right back. Until then, I do want to go ahead and show you guys a few new features that we added to Club 500's websites. Of course, we have about, photos, events, but we also added a turnkey deal page that allows you to essentially see some of what Club 500 is looking for with out-of-state purchases, with the properties that they're looking for, such as having purchase homes around $60,000 to $80,000, around $850 a month in rent, brand new HVAC units, hot waters, heaters, newer roof, new LVP flooring throughout the house, and so on. This is a home that was recently sold, so you could essentially come to club500.us, check out some examples of the properties which they're looking for. And Nick, since you're on, do you want to actually go ahead and maybe talk about some of the properties that you guys are looking at until we get this thing going?
Sure, yeah. We're going to be doing a trip out to Mobile, Alabama the weekend after Labor Day. So don't know the dates off the top of my head, but I know I'm going to be in Montgomery, Alabama the weekend before Labor Day, and then Mobile, Alabama the weekend after Labor Day. So I'm looking forward to that. We're looking at taking people that are interested in whether it's going to go see turnkeys in Mobile, Alabama, or going to look for opportunities in Montgomery the weekend prior. We're definitely going to have some turnkey opportunities that we'll be seeing those 2 weekends.
Love it. And so again, on club500.us, if you go to turnkey deals, you could essentially come and check out what they're looking for and actually contact Club 500 if this is something that you're looking for or want to get more information on. There are a bunch of photos that we have from events before COVID-19, of course. We have events, but if you go to events and scroll over, you'll see videos. If you click on videos, you're actually able to watch all of the past virtual meetings, at least that Club 500 has done. And this meeting is also going to be recorded, so please feel free to share it on social media with your friends. At the very end, we're going to actually be doing a Q&A. And so any questions that you guys have throughout the presentation, please use the group chats on the Zoom meeting. If you guys don't know how to access that, if you essentially on your Zoom menu, if you're looking at the video screen, you'll see a menu on the very bottom. You'll see a little chat box. I'm going to go ahead and put a message. So if you guys have questions, I'm going to be monitoring the chat box throughout the meeting. So please ask questions through the chat box and I'll make sure that we address them. Okay, everybody, good evening and welcome to Club 500's virtual event. We're going to be kicking this off, but before we go over the meeting, again, I just want to remind you that any questions that you guys have throughout the meeting, go ahead and use the chat box and I will be sure to address those meetings as we go. And you guys are currently going to be muted, but I'm going to actually unmute everybody because we're actually going to be doing a literal introduction before we kick off this meeting. And so essentially, just please state your name and just where you are from. If you want to promote a website or what you do, use a chat box, but I'm going to go ahead and kick this off and unmute everybody. So let me go ahead and unmute all the audiences. My name is Jarrett Richards from Newport Beach, California. Peter?
Hey guys, Peter Skobik from Orange County, California.
Hey, my name is Erhan Arat. I'm from Brea, California, and this is Aya, the newest Club 500 member.
Really quick, if you guys could unmute yourself, and if you want to go ahead and just introduce yourself, just go for it.
My name is Aurora and Eva, and I'm a Peter's wife from Orange County.
Hey, Zal. I'm also from Brea, fellow real estate investor and CPA.
My name is Matt Everling, and I'm from Temecula.
Jason from Long Beach.
Oh, Scott Gelb from Los Angeles.
I'm Ryan Dana from Mission Viejo, but now Oakland.
Hi, I'm Bassam Hello, and I'm from OC as well, Orange County.
Mike Moder from Long Beach, California. Melinda Vaughn from San Diego.
Nick Weaver from Murrieta, California. Run the Temecula Club 500 and the San Diego Club 500.
Guess I'll go. Hi, I'm Harriet, realtor licensed in Texas. I'm in Irvine right now, but I can help you with your boots on the ground realtors anywhere in the United States.
Kent Keys, Brea, California. Some Brea people in the house.
For everybody that has just joined, we are doing introductions for about 3 more minutes longer. So if you want to state your name and where you're from, please do so.
I'm Nick Chambra from upstate New York.
Hi, I'm Kim from Huntington Beach.
Scott or Steve?
All right, first time using this on my phone. I'm Steve from Los Alamitos, California, North Orange County.
And again, for everybody that's just joined, we are doing introductions. So if you want to state your name and where you're from only, please do so.
Hi, I'm Renee from Irvine.
Hi, I'm Irina. I'm from Costa Mesa.
Hi, I'm Malik from Orange.
Spencer Johnson from Anaheim.
Nicole Johnson, Falcon Property Management, Atlanta, Georgia.
If you guys want to go ahead and unmute yourself and state your name and where you're from, we're going to go ahead and do introductions for about 2 more minutes. Anybody else? Okay, one more thing that I do want to mention, Peter, if you want to go ahead and take over and talk about Alex Lemonade, and then we could go ahead and get this meeting started.
Welcome, guys. As I always say, we've partnered with Alex's Lemonade, which is a foundation for childhood cancer. It was started by Alex Scott, which is the girl in the picture there. She started selling lemonade in her at the age of 8, but her legacy carried on, and they've raised over $200 million so far for childhood cancer. We've gotten close to about $2,000 so far in the last few meetups. So super excited about that. I keep promising this, but we are going to have a link on our page to the Alex's Lemonade Stand donation page. So if anybody wanted to contribute to that, you'll be able to do that. Jared.
And so with all that being said, welcome to Club 500's virtual meeting. Today is going to be covering real estate lending in the COVID-19 environment, presented by Peter, and excuse me if I'm saying this incorrectly, but Parham. Peter, if you want to go ahead and kick off the meeting, it's all you.
All right, guys. Yeah, excited to have everybody here. Some faces, some old faces, and some new faces. Welcome, everybody. I'm very happy to present Graham Parham of Highlands Residential Mortgage. Graham's been in the industry for a solid 20 years now and has done thousands of loans. And he's a mortgage loan officer, and he specializes in investor loans. So it's been great working with Graham. My first several properties I bought, I was working with Graham on those because they were Fannie Freddie standard loans, and the first 10 of them you can do that way, and then after that I had started going commercial, so that was I couldn't use Graham anymore. But I recommend him to everybody that I know, because it's been really amazing working with someone who knows what investors are looking for, who specializes in working with investors, and who isn't a real estate investor himself. So that really makes a difference in finding a lender. So we'll get to that in a second. But first, I want to tell you guys, I'm actually in the office here with my wife and with Eva. You've seen them on video there. You might hear my baby in the background a little bit. You might see a diaper or two here and there. It's all here, but it's going to be hopefully a very good value add meetup for everybody because Graham has a lot to share and he's got a lot of knowledge in the industry, and I've got a lot of questions for him. So without further ado, Graham, Parham.
Well, thanks, Peter. Good to see you again. I'm the only guy from Dallas right now. Everybody else is in California. I think there was somebody maybe outside of California. Maybe it was Nicole. I can't remember. But yeah, I've been at this for 22 years. All I do is work with investors. We'll probably close, I don't know, on average 60, 70 loans a month for people just like yourself that are looking to buy those properties to buy and hold. I am not a hard money lender. I'm not a commercial lender. I'm strictly Fannie Freddie. So I'm, if you've got those properties that you're out there buying and flipping, that's great. But if you're buying and flipping and holding, we certainly can help you with that area on the cash out part. But as Peter mentioned, I've been at it for 22 years and work with investors like yourself for that long. And I am one. I jumped in about 16 years ago. Just closed on one last week and hopefully close one next week. One up in Memphis, one in Indy. So I'm all over the country, and I'm up to about 25 loans now. I'm not a flipper. I got a full-time job, so I'm a buy and hold. You bring me a property, it makes sense, like Peter, I'm going to buy it, and as long as there's strong management behind it, I'm good to go. So yeah, I've dealt with a lot of things over the years, and my goal really is to help customers like yourself stay on the right track, building their portfolio from a buy and hold standpoint, because I've always said some of the smartest people out there can make the dumbest mistakes, and I'm one of them. So you can't make those mistakes, but there's a lot of things that are going on in the industry right now, and in my opinion, it's all positive, but I'm sure a lot of people have some questions, as it pertains to the COVID, the forbearances and everything else. We can certainly answer all your questions. Peter, I think you're muted.
Peter. Yep. Hold on 1 second, guys.
Jarrett.
Yep, you're back.
Okay, good. Yeah. He kept saying you can't unmute yourself because the host muted you.
Oh, sorry.
All right. Yeah, welcome, Graham. So I wanted to say a couple things about Graham first. So when I first called Graham, I think it was 2015 or 16, I can't remember. So I called Graham, and I was hanging out at the neighborhood pool, and I was listening to podcasts, and I heard Graham on a podcast, and I thought it'd be really cool to have this guy do my loans because he seems to know a lot, and I want to get in touch with him. So he left his phone number or something, one of the podcasts. So I'm saying that the problem was it was 4th of July, right? So everybody's off, nobody's working. And I thought, okay, that's fine. I'll just leave the guy a voicemail, and he'll call me back whenever it's not a holiday. So I left him a voicemail, and literally 2 minutes later, my phone was ringing, and it was Graham, and he was ready to do business. And we talked, we kind of set things up at that point. And I don't think I've ever seen that before. Graham always says he's a 24/7 guy, and I guess that's what that means. So that was awesome.
Well, the whole scheme of things, it is 8:30 where I'm at. So yeah, I am kind of 24/7.
Good, yeah. So we do have a lot of questions for you, Graham, and I guess for new folks, a lot of times after doing this so many times over and over and over, I kind of sometimes I'm surprised at the type of questions that new folks have. So I always want to try to start at the beginning. So if somebody was looking for their first house right now, and I think a lot of our investors want to know what is the process, what are the major components of a process that goes from the pre-qualification up to closing, what would be the first thing they do as they're starting to look for investment property?
Well, first thing you want to do is you want to call me, and I'll kind of do a preliminary screening, if you will, about what you do for employment, what your objectives are, what your goals are, and then I can kind of formulate a plan for them. But in the Fannie Mae and Freddie Mac world, it's very much the same as when you bought your house. We take a look at 3 categories. It's different from private money, commercial lending, everything. We take a look at your credit, how much money you make and how much money you have. It's that simple. And so a lot of the strengths that a lot of the individuals have is they always have a lot of money. Sometimes they have, they're self-employed, so we have to digest through a couple of years of tax returns, kind of get an average there. But what I'll do is once I've done my interview, we'll fill out the application, 10 or 15 minutes worth online. My team will call them back. We'll get all the necessary items to validate your earnings and assets, like tax returns and bank statements. And then once we get it, takes a couple of days to get your credit approved. Then we come back to you and say, oh, you're approved. Once at that point, go find a house, get a contract, send me the contract. If the property itself is appraisal ready, keep in mind a lot of people are buying some turnkey properties that's not quite appraisal ready, and they maybe want to do some cash out, whatnot. But I have to have the property appraisal ready because I don't want to have to send my appraiser out twice. And a lot of times they send it out and it's in, distress or it's in rehab. Some appraisers or individuals, they give their opinion. I want to make sure they give the full value of the property. So once we get the contract, it's appraisal ready, we'll engage the process. We'll get you out some disclosure forms. We'll get the appraisal, the title work ordered. And our average turn time is about 26 to 30 days, even with the COVID environment and all the crazy refinancing going on right now. The only thing that's really slowing us down right now is the appraisers because they are backlogged because of all the activity. But that's kind of the process. It's no brain surgery, and we keep you posted along the way. I'm going to tell you up front if you're good to go. If you're not good to go, I'll just tell you. It's really that simple.
If I may jump in really quick, Peter, we actually have a few questions right off the bat, unless you want me to wait. Okay. So Scott had asked, due on sale clause, transferring a property to an LLC after FNME financing, the consensus seems no concern, but any changes in this current environment?
Well, if I had $1 for every time I had that question, I'd have a lot of money. On the record, yes, there's a due on sale, which means that if you transfer the titlement of the property to anything other than your individual name, the due on sale clause could potentially be called. Now, with that said, I've been having this conversation with investors for 22 years. I am one. All my properties are in asset protection. They're all in LLCs. What I do personally, 99% of my clientele will do, is they'll go ahead and fund the loan in their individual name. Then wait about 3 or 4 months. And the reason why 3 months is because when we sell these loans to Fannie, they in turn will bundle them up and deliver those out to investors. The investors that are buying these loans, they're going to go through and do a due diligence. They're going to re-underwrite the loan. And during that whole process, you don't want to stir the porridge because the dust hasn't settled. Of course, the servers are setting up the whole 9 yards. So once that kind of 3 month has taken through, get your deed of trust, get your LLC documents, send it over to your escrow officer or an attorney and have them retitle. Now, with that, you don't want to pick up the phone and say, hey, Mr. Servicer, guess what I'm doing today? Of course, the person on the other end of the phone reading the script with $8.50 an hour going to say, well, I think we're going to have to call that note due. I've been doing this, guys, for 22 years. I've had this sermon for 22 years. I've yet to see one note called due. You stop payment on the loan, they'll call it due. Beyond that, they really just don't care.
So for the bank, the loan is a performing asset, right? So as long as you're making your payments, that's all they care about. Yeah.
Yep.
One other question was if you are licensed in all states.
I'm licensed in 25 states. I'm in your backyard, of course, in California. Do a lot of business there, but I'm in most of your demanded turnkey markets. And Peter, you'll understand what I'm talking about. Most of those markets there where the investment properties do make sense. And I refer to it as turnkey markets because those, people that are in those markets have already figured it out that these are good return on investment markets. And I'm just going to name a few, of course, Dallas, Houston, Memphis, Kansas City, St. Louis, Chicago, Ohio, there's Columbus, Cleveland, down in Florida, there's Tampa, Orlando, Jacksonville, Atlanta, Montgomery, Birmingham, Charlotte, Cincy, I mean, I'm in Detroit. I'm in a lot of different markets, about 25, but I'm not total US. So I do have a list that you want to go to on my website. Then, and if you want to email me, I can provide that whole list of where I'm at.
We're also going to post all the states where Graham is licensed in, and we're going to post the markets that he's talking about as well on the Club 500 website, as well as a link to where you can find out more about Graham and his website and all the contact information.
Another question was for those that request forbearance as precautionary measures when COVID hits, but since then have been current on loans, what is a time frame we must wait until we could purchase properties again?
That forbearance piece has been kind of a tricky situation since the get-go. We, the industry, and everybody else kind of thought it was a negative. In my opinion, it still is a negative. But people, do file forbearance. We thought before, say, 3 or 4 weeks ago that when you're in forbearance, you've done it, whatever the case may be, you're out of it, you're going to have to wait a year before you get a loan. That's what we thought was coming down the pipe. The good news is that's not the case. And forbearance can take on several different characteristics. Student loans, people are deferring those. Home loans, they're deferring those. Anything that's in deferment or forbearance has to be completed. As an example, if you filed forbearance 3 months ago and you're on a 3 months forbearance program and you've got to the end of the forbearance, you've gone to the service and say, okay, I'm at the end of the plan. I'm going to go ahead and get caught up and I'm going to pay all the 3 months. Great. Some servicers will defer the money to the back end. That's fine. You have to deal with the servicer on that. The bottom line is, and I'll just read you the quote here. It says, as long as the forbearance and deferral, is paid in full and current, that's all we care about. So that's good news, okay? So if you're current and you're paid in full and it doesn't show up on your credit report as in forbearance, because it does, we want to validate that. We'll just get information from the servicer showing that you are current. So this is all good news. So we're not penalizing like we did back in 2008 when we were doing those loan modifications and deferments. That's where it came back to haunt you, where you couldn't get a loan for 2 years. We thought that was coming down the pipe, but didn't. So Fannie, Freddie, and all the government institutions were a little bit more lenient. They're saying, as long as it's paid up, you're good to go.
Next question was, how long is pre-qualification valid?
It's really indefinite. We pull the credit up front, and it's good for 120 days. We do not pull the credit again until you actually do have a contract and ready to go. So as long as you don't, change anything in your world, go out and buy a boat, lose your job, spend all your money, and if everything that we have up front that we validated is still there 3 or 4 months down the road, then we're good. So really, it's indefinitely as long as you don't radically change your environment.
Sweet. What is your underwriting criteria with respect to LTV and DSCR? What is a criteria for the buyer with respect to credit and debt to earnings? And credit to debt to earnings, excuse me.
Well, you're going in two arenas. The DSR is more of a non-recourse or commercial type lending, portfolio lending, if you will. The DTI is more of a Fannie Freddie type of scenario. Your minimum credit score for us, where other lenders right now are determining they want to have an extra added layer of risk, so they're raising those credit scores. We're not. We're all the way down to 620. What we do is we take your income and we take your debt, we do simple division. And as long as we can stay below 50% on those ratios, you're good to go.
What is your LTV for cash out refinances right now?
On a single family, it's 75%. 2 to 4 units, it's 70.
Hey, Graham, could you please explain for everyone the difference between QM and non-QM loans? What are Fannie Freddie loans versus commercial loans?
The non-QM, and I'm in that non-QM world myself. I've got, like I say, 20 something properties. So I'm fannied out. I can't do any more Fannie loans. So I'm in the DSR category, which means that I don't even provide income documentation. I look at my assets. They look at my credit. Some lenders will want to see if you're a tenured landlord or not. Some don't. But they underwrite the property. They want to make sure they see the performance of the property, and then they back into a loan to value at that point. Those are your non-QM. QM stands for qualified mortgage. Qualified mortgages are Fannie Mae and Freddie Mac.
So Fannie Mae and Freddie Mac end up buying those loans?
Correct.
From the loan service or originators, I guess.
From the Fannie Freddie like myself, correct. And just kind of give everybody a brief history. I'm going back to the beginning of March. The rates fell. We all know that. Everybody and their mother came out of the woodwork and said, let's refinance their house. Our average funding year in conventional lending is $4 trillion a year. In those first 2 weeks of March, the industry took $1.3 trillion of application. It crushed the system. The feds have had to jump in a half a dozen times buying billions of dollars of mortgage-backed securities just to keep the originators afloat. Consequently, what has happened, which many of you probably have been affected by it, because I know I was in the middle of an exchange the third week of March. Had 3 going. The first one funded on Monday. They called me back on Tuesday, said the other 2 are not going to go because they pulled the plug. So all your non-QM, convention or commercial, you name it, everything other than Fannie Mae pulled the plug at that point because of the liquidity problem. And then to compound that, here comes COVID on top of that with forbearances. So the servicers, they were stressed. They were their maximum capacity. They couldn't fulfill their commitment. So it's been a bit challenging. We're starting to see the light of day. Some of the industry is starting to catch up. I'm seeing some of the non-Q lenders barely come back on board. I'm in a holding pattern now. I've got a contract right now up in Tennessee that I'm dying to get on with one of those non-QM lenders. So they're slowly coming on board. One's coming on first of the month. Another one came on board last week. So those guys are coming back on where they left the playing field back in March, and they've been non-existent. I'm sure some of you guys have probably experienced that.
Can you clarify for everyone, when you or any other lender are talking about 1 through 4, 5 through 10, what are you talking about there?
Well, the rules have changed over the years where we can go all the way back to 2008. Everybody had a knee jerk. Fannie Mae cut it back to 4. So we stayed there at 4 for maybe 10 months. And Fannie, not Freddie, but Fannie came back and said, no, we're going to take it back to 10. But they had more stringent requirements where you go to a certain amount to a certain credit score to 4. And then after 4, you had to have a certain credit score. And that still takes place today. Up to 6 loans, we'll do 620 or higher. And then 7 to 10 loans, we have to have 720. So that's still in place for both Fannie and Freddie. They did cut back the LTVs, but the LTVs are still healthy. Like I say, we can do 20% down on purchase for single family, 25% for 2 to 4 units. But really, I mean, it's kind of business as usual. Some of the lenders are a little bit scared. Chase Bank has a good example. Is there anybody here who works for Chase? I hope not. But they were the first one to have a knee jerk with this whole COVID-19. They came back and said, okay, no more HELOCs, which you guys got creamed on. I know everybody else did. They said, okay, we're going to throttle back to a 30% down requirement just on single families. And we have to have a 700 credit score or higher to do any loans whatsoever. Now, has that changed since then? I don't know, but I've been receiving a lot of phone calls from people who said, hey, I was with Chase. I was pre-approved. Now I'm trying to get a contract. And they're coming back saying no. So the flavor for risk for these institutions until they all come back and get caught up, they're healthy again. I mean, they're a little bit restricted, but we're not. We sell directly to Fannie. So it's been great for us.
Yeah, I always tell everybody to stay away from kind of the big name banks, the big few banks, because they're always, they're a lot more stringent. They have, their requirements are a lot more strict for what type of loans they're willing to give. And I find it better to work with either a community bank in the community that you're investing in, or with a specialized lender that deals with investors only. So that's definitely some advice for new folks. And so, Graham, what you're saying is properties 1 through 4 are kind of the easiest ones, right? The ones where it's kind of easier to find to get the loan, or
Well, it used to be 20% down up to 4, 25% down after that. We go all the way to 10, 20% down. The only thing that changes when you get 7 to 10 loans, you have to have a 720 or credit score or higher. Other than that, everything else is exactly the same. So these are some old rules, Peter, that you're kind of throwing back out. That was back a couple of years ago. And there's some lenders out there that still have those on the books, even some of the big guys, but we don't.
Yeah, so for everybody, so that's really good news that now for Fannie and Freddie loans, for your first 10 properties, you guys can get better rate, less money down, all of those things that you won't be able to get once you pass that 10 property mark. So that's why I'm not even aware that this changed, because I passed that a couple of years ago.
And our rates especially. I mean, the rates right now are crazy stupid. They really are. Once again, I'm in the non-QM world, so I'm looking at a 30-year fixed rate right now on a 25% down on a single family, 6.5 on the rate, okay? Where if I was inside the Fannie box, I could get for 25% down 3.375 today with no points. It's stupid right now. So people are coming out of the woodwork, and it's great. There's blood on the streets. Go for it. The opportunity is now.
I actually do have a question on that nobody's been able to answer for me clearly. So let's see, I'll put you on the spot here. If I'm maxed out on my Fannie Freddie loans, let's say I have 20 properties and half of my loans are Fannie Freddie and half of them are commercial. If I sell off a couple of the Fannie Freddie properties, does that reset my number then? Or if I refinance all of them with a commercial loan, does that reset my number? Can I start buying Fannie Freddie properties again?
Yes and no. And here's one of the biggest mistakes that people make because they just don't know. Let's say I've got 20 loans and I want to do exactly that. I want to clean the slate. I want to put them all into one commercial loan and one big blanket loan. And I'm going to take them and put them in my commercial category, and they're not in Fannie and Freddie, and then I can go restart my 10 inside the 10 bucks. You can, as long as that loan is a full non-recourse loan, which means that the guarantor of that loan is not you individually. It's an LLC, it's an entity. That's what the full non-recourse means. So a lot of people will go do that with a commercial lender. They'll throw a dozen properties into a commercial lender. Hey, yeah, I just got to wiping it out. Send me a copy of the note. I look at the note. Their name is right there as a guarantor. It didn't help them at all. So just be careful of that.
That is the best, most complete answer I've ever gotten to that question. Jared, any more questions from members?
Yes, there's a handful actually. So before I get to the other ones, a yes or no question regarding if you're licensed in Michigan. That was, I did miss that one and I didn't want to.
Yes.
Yes, okay.
I do a lot of business in Detroit.
And then the next question was, are you familiar in dealing with a rate and term refinance on a private loan?
Well, a rate and term is a terminology that basically says we're just refinancing the balance. If you have a private money loan, commercial loan, any kind of loan, or which is a lien against the property, you come to me and say, I want to take out that private money loan. I want to refinance it, and I want to put it on a Fannie note with a much better rate. All we're doing is paying off the balance. Whatever closing cost is, roll that on top, and that's called rate and term. Now, the cash outs are different, okay? That means you're walking away with money. And one of the things that I wanted to stress with you guys, because I know that you guys do a lot of flipping, and you want to get some non-seasoned cash outs. So just make sure we're all clear on that. There's seasoning and non-seasoning. The seasoning is you wait 6 months, you can get the full property value and take the full maximum percentage out of the property once you own it for 6 months. Inside the 6 months, the way it works is, let's say you buy a property for $60,000. You put 20 into it. Now you're into it for 80. We run an appraisal, it comes in at 100. I'm going to give you 75% of cash out on that single family. So now we're at 75,000. But in the first 6 months, I can only give you back what you paid for it, which is the 60. That's where a lot of people get confused, okay? I can get that 60 back for you, but I can't give you the full 75. So keep that in mind.
And Graham, how long does it take? So let's say if I were to buy property cash today, when could I get a loan on it?
Start tomorrow.
Okay.
Yep. That's
I don't
another.
have to wait 6 months or something. I've heard of 6 months before.
Well, the 6 months, once again, if you want to get if you buy it for 100,000, you know it's worth 100,000, but you pay cash because you were in a competitive bidding situation that you had to do cash, not a problem. I mean, we're going to give you, 75% of 100,000 if that's what it appraises for.
I think you and I ended up doing that one time because I had a pending loan for a duplex in Georgia, and it fell through just about a week before because I had my 2015 taxes. We were redoing something, having them refiled, so I couldn't provide a 2015 tax return. And for that property, I ended up having to pay cash, and I think you and I refinanced it actually.
Yeah, I do remember that.
Is that what you would call delayed financing then?
That's exactly what it's called, delayed financing. And delayed is in that first 6 month category. After the 6 months is not delayed because you've waited 6 months.
Jarrett, let's do a couple more
100%
questions.
Do you offer the Fannie Mae home style loan?
We as a company do. It's not available on non-owner occupied transactions.
Can you escrow rehab funds on a Fannie Freddie loan?
Most likely not. The only time we ever have to escrow is, let's say, the property is 100% complete, but it doesn't have the HVAC, and you got to close tomorrow, and the HVAC won't go in until a week later. Stuff like that. It's case by case, but we're not a rehab lender, so keep that in mind. We like to see a finished product, an as-is property, but every now and then we run into a situation where we require that. We just don't do it a lot. They're very difficult to do. We have to trust the seller. We have to trust the buyer that these items that are in escrow will be completed and cured within a very short period of time.
Who do you go to for non-QM loans?
Me personally, I used to use Lima One. I got burnt with them in March, like I said. I know First American is coming back hopefully next week. I've been talking with her almost every day. There's a Lending One is another one out there that can do. Some require some landlordship, some don't. I think the majority of them do. Once again, their rates, sixes. I mean, I did one up in Indy last month, and I got a local bank there to do it. And I got a 30-year ammo. It was a 5-year arm, and I got it down to 5%. And then I did another one in Memphis, once again about another local bank, if you will. And I got 4.5 on the rate. 30-year, but it was a 5-year arm, but it was a 15-year am, which killed my cash flow. So that's why I'm waiting for these 30-year ammo people to come back on the playing field, because I got to have the cash flow.
Perfect. I'm super glad that you guys are getting a lot of value out of this. There's a handful of more questions. Peter, do you want me to continue to go through them, or do you want me to put a pause on the questions for now?
Absolutely. No, I would love to get through all of them.
Perfect. If someone has 9 Fannie Freddie loans, can you refinance them all at the same time, or do you have to strategically refinance one loan at a time?
All at the same time. We do 4 and 5 and 6 packs all the time on purchases. Doing 9 is just as easy as doing 1. It really is.
And I'm assuming this question may have been to something that you said earlier on, but I can't pinpoint it. But is that 10 properties total, including in your LLC, or 10 properties in your own name?
Well, if you can recall when I talked about having those loans in a commercial grade loan, if that loan, and the way it works is, Fannie says if you have a 1 to 4 family property, 1 to 4 units, and it's a residential property and it has a loan against it, and if you are the guarantor of the loan, that counts against you. If the LLC is the guarantor of that loan, it does not count against you. Doesn't matter if it's in your LLC or not. It all boils down to the note itself. Who's responsible for paying it?
For the folks who have taken an SBA loan from the CARES Act, how would that impact them in getting qualified for a conventional loan?
I got one. It doesn't affect you at all. I mean, there's 2 kinds of CARES Act. There's the one that I think you can do for like $10,000, and the other one is a true loan, I mean, we count it just like a car payment. I mean, show me the amortization schedule. You know, some of my friends did, you know, 60, 70, 80 grand for their SBA loans. Just show me the payment on it. That's it. It's just like another liability.
I messed up on that one. I'm never going to forgive myself. When I was filling out the application for it, at one point it was saying what's the income from rentals, was the all of that, and then it asks at the end it asked what was the cost of goods sold, and of course for rentals it's kind of like how do you like what's cost of goods sold, right? So I put just my cost of rehabs, and of course they just denied the whole thing.
Those loans are actually pretty easy to get. A buddy of mine got it, and just I mean it was like that. It's amazing.
Yeah, yeah. We have a friend, Nick. How many properties does Nathan have? And he got like 100 grand, right?
Nick, I know you'll be muted. If you could unmute yourself. If not, I just asked you to unmute.
He's got like, he bought a portfolio of 22 houses, and I think he had a quad in Hemet, so he's up to like, you know, 27 houses, but he ended up getting 100 grand in the SBA loan.
Still 100 grand is a lot for just 27 properties.
Yeah.
That's amazing.
It's almost like free money, isn't it?
It is.
Except you have to pay it back at a very low interest rate.
That's true. Very low. Like they're like what, 3.5? It's really nothing. Yeah.
Next question was, what are your lender fees, or are you able to provide a rate sheet? Are they competitive? I believe that's a more personal question.
Well, I can tell you right now, because of the liquidity problem, we got the hottest rates on the street. We really do. 20% out on single family, we're probably 3.875. 25% down, we're at 3.375. And that's with no points. Our lender fees are $1,194. Wherever you go, whatever transaction you do, that's our lender fee standard. And that's pretty competitive with the industry.
Yeah, it is. And another thing that I would tell you after buying so many properties and working with several lenders, including Graham for several of them, I can tell you one more thing that really matters is when you're in the buying process, and especially when you're buying, if you're dealing with multiple properties or a complicated situation, you really need your lender to be able to just push things through and work fast and just be very efficient. And I can tell you with Graham, literally the first property that I was buying was very typical, you know, just you're submitting all the documentation and all of that. And with the next one, we were already getting to much faster because a lot of things were already on file. And by the 5th or 6th or something like that, I would literally send him the address and the signed contract, and he would ask me for updated pay stub. I would send that, and he would say, yeah, we're good to go.
Yeah, we do hold all your stuff, so we just cut and paste. You don't have to fill out any more applications.
Yeah, the application was always filled out, and it's just very nice.
In comparing paying cash and refinancing versus financing purchase up front, are the closing costs similar, or does the refinance tend to be less?
Well, the only thing that changes is your loan to value. You can buy a single family with 20% down. If you pay cash, when you come back to do a cash out, you're limited to 75%. The cash outs right now are somewhat challenged. California is one of them. I mean, there's a lot of lenders right now that stopped doing cash outs in California. We're doing a bunch of them. And even if they're doing them, they're raising their rates significantly. I mean, we're talking a full point. So it's, in my opinion, it's always best to do the purchase loan because you get your full loan to value of the 80%. The fees and everything are the same. Basically, everything's the same.
Can you clarify for everybody the investor interest rate versus a home buyer interest rate? Because I've had some questions from new investors in the past. They were saying, well, I saw out there that you can get a loan for 2.9%, and they were trying to buy an investment property and kind of expecting the same rate.
No, there's usually a differential of about a point, okay? Although that has narrowed in the most recent day because of where we're at. As an example, I locked in a cash out today on a primary residence up in Washington, and they got 2.875, where here I am offering 3.375 on investors. So that point has shrunk a bit. So in the owner-occupied world, they're probably 2.6 to 2.8, somewhere in that ballpark. And once again, I mean, if you look on the internet, they're all over the place, but that's pretty realistic.
I don't know if anybody got a chance to listen to the audiobook or read the book. I think it's the Millionaire Investor. I think that's the name of the book, but it's yeah, Millionaire Real Estate Investor by Gary Keller of Keller Williams. I was listening through that book for the third time. I really love the book. I love the way that he writes and breaks everything down. And it really put things in perspective because he wrote it, I think, in 2003. Okay, so he was talking about the properties that he was buying, the type of prices he was paying, the type of rates he was paying. And he was giving examples of a property. And he says, it was $170,000. The rent was $1,360. And he was paying 7.43 interest. Thought it was a great deal, bought it. Very happy with it. So I think about that. I mean, you take a look at 170 grand where the rent is $1,360 a month. That in itself, I'm already not too excited about it because I'm looking for at least a 1.3% of rent to purchase price ratio. And you look at the properties that Gary Keller was buying then, they were at 0.8%. And his interest rate was 7.43, which we wouldn't even dream about now. So it's funny when the rates go from 3.something, 3.4, 3.6, they go to 5%. Everybody's already thinking, wow, these are really high. But when you look historically, in 1982, a 30-year fixed mortgage was 17%. So these rates are really insanely low, even pre-COVID.
That's so true. I can't begin to tell you. I've worked with investors for, like I say, 22 years, and I've got one of my preferred customers in San Jose. He's an accountant by trade. He's been working with buying properties since the early 80s, and I love to hear it coming out of his mouth. He goes, "Man, if you can get below 7% on an investor rate, you're doing good," and that's still true today. When I was buying 16 years ago, I mean, I had some 7.25, 7.5, 7.75. I still made it work. We are just spoiled, bottom line. We truly are.
What do you think of Corvest?
If they're back on the playing field, I think they do a good job, and that's probably a good company to consolidate your loans, if you will, like we described, taking 20 loans, putting them together. That's what I know that they're known for, to do a very good job. Beyond that, I don't know much about them.
What is your projections on the market and foreclosures given the unemployment and all the potential defaults on rent and mortgages once the protection is over?
Ooh, and I'm not sure if I can answer that. I think that the rate environment is going to stay steady for quite some time, and I mean more than a year, okay? I mean, the feds have to do something to, keep the economy in line, so that's a good thing. I haven't seen, because I work all over the country, I haven't seen hardly any markets move whatsoever in values. That's a good thing. We were expecting that to happen even in the last 3 or 4 months, and we haven't seen anything. Rents have been good. They're running about 92 to 95% across the country. That's a good thing. People are going to still have to have a place to live, okay? Now, you guys in California, you do this, so you're always nervous about what's going to take place, and you're probably the first to move. But from what I can tell, I haven't seen hardly any markets move yet, none whatsoever. Now, to project what it's going to do, then obviously I'd be living on Wall Street.
And plus, we're recording this call, so we could always rub it in your face.
If I am refinancing my 9 Fannie Freddie loans and I have the majority of my deeds in my LLC, do I need to reconvert my deeds back to my personal name before I can refinance?
Yes. Remember the example I gave you a minute ago? If you bought a property, then wait 3 or 4 months. Well, yeah, go ahead and deed it out and put it back in your individual name. Let us refinance it, and then wait 3 or 4 months to throw it back in your name. Happens all the time.
How long do you anticipate us seeing these crazy rates?
I'm thinking at least a year. I think the economy is going to be like that for, I mean, in my opinion, because of the COVID, what's happened, it's going to be a 2-year recovery. And, the rates could hold that long. I don't know. I'm not an economist. But I think personally it's going to hold at least a year.
What are your owner-occupied rates right now, 30-year SFH?
FHA? Ooh, I don't do a lot of FHA. I'm going to say in the mid twos, just to take a wild guess. You'll have to call me and I can certainly look it up.
Misunderstanding. I think it was saying 30-year single-family homes.
Oh, thank you.
Yeah, in the mid twos.
Guys, if you have any more questions, please use the chat box and I'll be sure to address it. I actually have a question myself. Nick, I know does something pretty similar, may be able to answer it. If I was in a position where I don't have any investment properties under my belt, but was looking to partner with a funding manager and be the active manager behind it, what is the best way to set up that loan if I partner with someone?
And I had this happen a lot with individuals, brothers getting together, business partners, husbands and wives. When we look at a loan for Fannie Mae and Freddie Mac, we look at the three categories. Your credit, how much money you make, and how much money you have. And that's the key right there. Let's say you and Peter decide to join together. You want to go buy your first property. Great. Peter gives you $50,000. You put it in your account. I'm going to come to you and say, send me your most recent 2 months bank statements. I'm going to see this deposit on there for $50,000. I'm going to say, where'd it come from? You're going to say, well, I got it from Peter. I'm going to say, I can't do that. That's considered a gift, G-I-F-T. Okay. So what you have to do is you have to have those funds seasoning. So I had this happen quite a bit. If you're out doing a partnership like that, let the first guy go first. Look, Peter, you do the first loan, he'll do the second loan, vice versa. And if the funds themselves are commingled, make sure they're commingled in an account with both your names on it. Okay, that we can do. Even if it's you call it an LLC account, because Peter will give you permission to utilize those funds or access those funds for a real estate transaction. Now, that's a way of getting around doing that gift. Okay, putting it in a joint account.
In a bank joint account, you mean?
Say again?
You mean like in a bank joint account?
Yeah, like a joint bank account, correct.
So if I'm not mistaken, lenders usually require 6 months of principal, interest, taxes, and insurance on all properties, including the one that you live in, the one that you own. Is that the case for you, 6 months, PITI?
That's the old rule. The new rule that came into place a year ago, maybe a year and a half, is for the first 2 properties, we take an aggregate amount of the outstanding loans and we want 2%. As an example, you got 2 loans, $50,000 a piece, it adds up to $100,000. Your reserve requirements is 2%, $2,000. 4 to 6 loans, I don't have to go back to look. It's in my book. I can never remember this. It's either 1 to 4, 4 to 6 is 4%, and then 6 to 10 is 6%. Okay, so it's of the aggregate amount, which means we'll say, okay, how many loans you got? What's the total amount? How many loans do you have? We figure out the percentage, and that's what you need for reserves. Now, the good thing is reserves do not have to be liquid. Show me a 401k, IRA, whatever you got. I mean, we'll use 60% of the asset, actually 70% of the asset. So it doesn't necessarily have to be liquid funds. Now, a lot of people will try to do HELOCs to go out and use for their down payment and closing and everything else. And we can do that because the HELOC money is your money, it's your equity. So we will honor the HELOC funds for down payment closing, but we won't on the reserves. Just keep that in mind.
Can retirement accounts be used to prove the required reserves?
We just get a copy of the statement. A lot of times, it used to be we would have to get the full plan, I guess, if you will, saying, okay, can you really get to these funds? Will your corporate 401k allow you to get to these funds for whatever reason? We don't ask that anymore. You just show me the asset. You got 100 grand in it. We'll give you credit for 70,000.
He gave us an example of only being loaned out the cost of a house instead of the 75% of the ARV. Under what conditions does that occur?
Can you repeat that?
Michael, he gave an example of being loaned out the cost of the house instead of the 75% of the ARV. Under what conditions does this occur? Michael, if I'm not asking the question correctly, if you want to unmute yourself, I just asked you.
Oh yeah. So I heard part of what you were saying, that the example was if you purchase a property for 60,000 and put 20,000 in, and it appraised for 100,000, that you could only get loaned out the 60,000 instead of the 75,000. I was just wondering what circumstances does that occur?
It's within the first 6 months.
Oh, okay. Just after the 6 months, that's after the full seasoning period, then it'll just be the 5%.
Correct.
And if you did do that, if you did refi prior to the 6 months, could you come back again and get that additional 15,000, or it'd be a whole nother process?
There's no gray area. It's either 6 months before or after, okay? One of the things I'll have to say for the non-seasoning in the 6 months, let's say you buy the property with a HELOC. Inside the 6 months, we are asking you to prove where that money came from. If it came from your savings, great. Show me the statement where you pulled the money from. If it came from a HELOC, then we're going to force you to pay that HELOC back, which is not all that bad. If it came from mom and dad, now we have a problem. Okay, so be careful when you get that money from.
Okay, thanks.
Really quick for a definition, when you say seasoned, can you define that? What you mean by that?
6 months. Got to have the property for 6 months.
Gotcha. Thank you. And guys, if there's any more questions that you have, please use the chat box. We have addressed all the questions so far. And so, Peter, if there's anything that you would want to cover, I'll keep monitoring the chat box for a couple more minutes.
One more that I've gotten from a couple of members, they were noticing that, folks who have been investing for a while, they were noticing that they used to pay $400 for an appraisal. Now they're paying $600 for an appraisal, $650 for an appraisal. And the appraisals in general cost a lot more than they used to. I know the answer to the question, but I wanted to see if you could explain what happened.
No, it's a fair question. The average single family appraisal, just the standard Fannie 1004 form for like owner occupied, $450, somewhere in the average. On investment property, we have to get two additional reports. One is called the average market rent analysis, which is called the 1007, and also the operating income, which is called the 216. You take those two reports and add it on top of the normal Fannie 1004. The average on a single family across the country is probably $550 to $595. The only time it exceeds that is on the 2 to 4 units because there's more work to be done. So you say $650 on those.
And I heard that after Dodd-Frank came out that now the banks no longer have the ability to select the appraisers and they have to go through third-party companies that also upcharge a fee for that.
Well, I'm not going to deny that some companies out there do upcharge. We don't. We just pass it along. The Dodd-Frank Act that came out with a thing, as you were referring to, it's called the HVCC. 2010, anybody from New York? No, good. Perry, I think it's Como is his name. He was the attorney general at the time. I think he's governor now, whatever. But he decided to make a name for himself, and he went toe-to-toe with Fannie Mae with fraudulent appraisals, people inflating the appraisals. So he wanted to make everything fair and just, and Fannie Mae just kind of said, okay, fine, what do you want? So they came up with this thing called Home Value Code of Conduct, HVCC. So what that means to you is, before 2010, Peter, you come to me, hey, I got a property in Atlanta, I'm trying to refinance it. What do you think it'd run? I don't know. Let me call my appraiser. Hey, what's this property on 8th Avenue? What do you think it appraised for? 100 grand. Perfect. I'll send you the order. We're going to get 100 grand because I've already talked to the appraiser. All that's gone away. We have to set up a panel. Every lender has a thing called an EMC, which is a third-party company that will set up a panel, if you will, of individual appraisals. Appraisers. We fortunately have, in what I do for a living, because I'm in so many different markets, I have my own separate panel per market. Like Detroit, we have 5 individual appraisers there. But I don't know which appraiser is going to get it because the laws prohibit me from knowing that. I can't even talk to the appraiser. I can't even find out who it is. The only time we'll ever find out who the appraiser is when they call the seller and we get the report. It's not a fair way of doing it. I hate it. The entire industry hates it. if anything could ever be changed on Dodd-Frank, I wish they could change that, because I tell everybody in every market, my weakest link is my appraisers, because I don't know what they're going to do. I mean, they're just, is anybody appraiser in here? Hopefully not. I mean, they're just a bunch of good old boys. They really are driving around their pickup up trucks, making snapshots and measurements and coming up with an interpretation. I've always said you put a dozen men in a room and give them a case of beer and some beef jerky, they're happy campers. And they're just good old guys, but they don't like to be challenged. You come back and say, okay, I'm selling this property for 125 and the appraisal came in at 100. Everybody's upset. And they go, well, let's go to order another one. The HVCC won't allow me to do it. It'll allow you to challenge the appraiser. But if you come back and challenge the appraiser, said, you didn't give us our best foot forward, and here's why, here are the extra comps you missed. 1 out of 20, he'll come back and say, well, maybe I'll change it. The rest of them will say, no, they won't. It's just the way it is. It's not a fair way of doing business.
All right, we're going to let one more question for Graham, and then we'll start wrapping up.
The last question, I believe Nick answered it. Just got one in. Actually, we'll use this one. For everyone else, where can I go get a HELLC right now, and what terms should I expect? Thank you.
A HELOC?
HELOC.
Oh, great question. Well, as I was mentioning to you a minute ago, Chase said, no, we're not stopped doing. A lot of people have stopped doing them temporarily. Getting them on your primary residence, in my opinion, is relatively easy. Getting them on investment properties, it's almost impossible. There's probably, I'm going to say 3 or 4 of them out there that will do it. I hate to say this, but Wells is one of them, very restrictive. Another one called, well, it's a credit union. I'm trying to think, it's like a Navy credit union or something. I can't remember. I'll think of it here in a minute. Very restrictive. I've tried to do it on a couple of my properties. I couldn't do it because I got too many properties or whatever the case. They're very restrictive. So getting a HELOC on an investment property, very difficult. Your primary residence, very simple.
Matt said Navy Federal, and Nick said U.S. Bank are doing them.
Wherever you can find them, go get them. I highly encourage you to get them. I love HELOCs. I got one on my personal property. I use it as a tool, like the property I'm buying next week. Instead of me coming up with the money, I'm going to go ahead and grab that 50 grand out of my HELOC, and I'll pay it back in a couple of months. It's a great tool to have.
Well, thank you so much for the questions, everybody. Peter, if you want to go ahead and take it from here, there's no more questions, and we actually answered them all. So.
Yeah, I've got one more announcement, but before that, thank you so much, Graham, for all the knowledge you've shared with us. I think folks always appreciate when we have a guest come on with that much experience and knowledge. They can ask questions directly. So sometimes we'll have an attorney, sometimes we'll have a lender or an insurance person. So we'll definitely do that a lot more going forward. And we'd definitely love to have you back in a few months again for another one of these.
Sure, my pleasure.
Thank you. And in the meantime, also wanted to make an announcement that our own Nick Weaver, who is currently running the Temecula and San Diego chapters of Club 500, is going to be taking a group of investors out to a couple of markets. So we've started doing this recently because over time we developed relationships between Nick and I. We've bought 60 properties so far. And between us, we've kind of met a lot of people. We've made a lot of connections in the industry. And so we basically are taking groups of folks out to different markets to take a look at houses, to introduce to lenders, the banks, insurance brokers, lawyers, turnkey operators, and things like that. So it'll be a really exciting trip. I think, Nick, you just came back from Montgomery. Is that right?
I just asked you to unmute. There you go.
Hey, that's correct, Peter. And real quick story with Peter and Graham. So Peter turned me on to Graham when I first got started in late 2017. And when I was working with Graham, one quick story, Graham, I brought him well, first off, I was buying property in Hampton, Georgia, which was Peter's best kept secret. So those were my first couple properties. And then I found out I was stepping on other people's toes in my office because Peter and I work in the same office. We were like outbidding each other for the same deals. So when I was on a phone call with Graham, probably on 4th of July, I asked Graham, hey, Graham, what other markets should I be looking at? Because I stepped on my boss's toes and I actually outbid on a property. So I don't want to do that again. What do you recommend? He says, I've got this turnkey provider that out of Montgomery, Alabama that I've been talking with. You should check them out. So Graham gave me the phone number of this turnkey provider in Montgomery, Alabama, which wasn't on any top, turnkey or top investors list. So I reached out to them. I saw their product, and then ultimately I ended up picking out some properties in Montgomery, Alabama. So one of the first properties I brought over to Graham. It was for $59,900. Do you remember that, Graham?
Oh yeah, and I will say, Nick, I like Montgomery. I've got 2 down there myself, and I've got some
only
boots.
2.
Well, I got some boots on the ground that they're sending me deals every day.
Yeah.
I want to expand in Montgomery. I like Montgomery. I like it better than I do Birmingham.
Yeah.
A lot of people gravitate toward Birmingham, but I do like Montgomery. One reason I don't like siding or tin roofs, I like bricks and I like cedar shingles,
Yeah.
I mean, they're quality build. It's a good market. It's got the military there, some manufacturing, lots of blue colors, really good strong rents. I love Montgomery. I really do.
I do too. I have over 20 properties there now.
Oh, wow. That's great.
I need to refinance some with you.
Bring them on.
Hey, so anyways, I told Graham, hey, I got this house for $59,900. He goes, Nick, don't you ever bring me a house that low priced again. You're not allowing me to make any money.
Well, and I'm glad you mentioned that. For anybody out there, we do have a threshold of $50,000 on the loan amount, and I did Nick a favor. But if you keep your sales price at 65 or higher, I'm good. Okay.
So back to Peter's point, I am doing an investor tour. I'm going to meet some investors in Montgomery on September 4th and 5th. It is the Friday and Saturday before Labor Day. And then I'm going to spend a few days with my realtor out there hanging out at her nice lake, right, Com? The nice lake in Montgomery. And then on September 10th, 11th, and 12th, I'm going to meet another group of people in Mobile, Alabama. And we're going to tour that market. And we have a turnkey provider out there with a list of homes that are in the $70,000 to $90,000 range. And I'm sure he's going to have stuff available to purchase for anybody that's interested. And these are all products that Graham would be able to finance with Fannie Freddie loans. So anybody that's interested and you haven't got your first property yet and you need to see it and touch it and feel it, I highly recommend you make the trip to Alabama. The flight sucks. You're going to have a layover somewhere. There's no direct flight, but it's well worth it. We're going to get a lot out of it. Every time a group goes with me, they're glad they did. I always have fun, and I think you'll really appreciate it. And if you're ready to pull the trigger, make the time to go to one of these, either September 4th and 5th Montgomery or September 10th, 11th, and 12th in Mobile. Right, Peter?
That's right, yeah. And actually, that's one of the markets where the rents went up even during the COVID timeframe. Bassam Hello over here was actually telling me the other day that he was reading an article about different markets and what they did during COVID. Some markets went down, some markets went up, and Mobile, Alabama is actually one of the markets that went up in rent during the COVID time.
Yeah, and so I'm actually going to be doing a Zoom call this coming Wednesday, just to talk more about those trips and give everyone a little more detail.
So if you want to know more as well, you can go to club500.us. That's our website, club500.us. And there's a link on there that says something like turnkey or turnkey deals. When you click on that, oh, there it is right there. So Jared, if you scroll down a little bit. So there's kind of an example of a house that recently sold. I can't remember the numbers of this one, but it sold for maybe, can you look at it? Okay, $80,000 selling price. It's rented at $975 a month with a tenant already in there. And it's completely rehabbed. Maybe you can, Jared, you can show some pictures. Yeah, there's some photos of what it looks like inside. And actually, you can tell over here, so the partner companies that we'll partner with, we really only have 2 right now. And that's for a reason. There's a lot of turnkey providers in the country, but we don't like the ones that don't really let you have any equity in the property. There's a lot of turnkey providers out there who are selling you properties that you're just not going to have equity in because you kind of overpay at the start. And if you were going to sell it, you would be left with nothing basically. So we only partner with folks that we know are going to sell you the house for what it will appraise for, with the luxury vinyl plank flooring all the way throughout, new HVAC units, a new hot water heater, and a newer roof. So that way you don't have a lot of expenses kind of going into it. So that way, you know, if you guys are interested, you can take a look at it on the website, sign up on there for the trip that Nick will be doing in both markets. And the trip is free of charge. Obviously, you just got to pay for your plane ticket and wherever you're going to stay. But I think it'll be a great experience. And based on the photos from the last one, it looks like everybody had fun. And that's it, guys. That's all for today. So we're going to log off now. I am really excited to see it, to announce also our next couple of Zoom calls. They're going to be every 2 weeks going forward, Wednesdays at 6:30. Next time, I believe we have Joe Holmes, the flipper here in Orange County. He does a lot of rehabs here. He's been doing it for 20 years as well. He's got a lot of knowledge to share. The next one after that, we're going to have kind of a newbie introduction with maybe 3 or 4 folks who just started investing in real estate, sharing their experiences and any challenges they ran into and any advice they can share with us. So hopefully that's going to be good for you guys as well. Keep an eye out on our emails. Look at your spam folder as well. Sometimes these things go in a spam folder and you don't even see it. But great to have about 40 folks here tonight, and look forward to seeing you guys again in a couple of weeks.
If I may, really quick, I do want to remind everybody that if you also go to club500.us, not only do you have the turnkey deals, but if you go to events and scroll under videos, this video is going to be posted on the YouTube. But you could also watch the past events. So there was a lot of great information that were shared today. I'm sure it was a lot of information. So you are going to be able to go back and rewatch it, share with other people, and so on. So if you go to club500.us, just go under events, you'll see videos, and it will take you to all the past videos.
This is also good, the page where we're going to put a button on there so you can download any information that Graham wants to share with us. So his contact information, the states that he's licensed in. Graham, if you just want to send me a file, maybe a PDF or something, I can just get it posted on there.
I'll do you one better. I've actually, since I told you I've been working with investors for 22 years, especially the ones that are just getting started. You guys ask all the same questions over and over. I said, fine, I'm going to put it into a guide. And I've got a really nice guide that I'll send you a copy of. You're welcome to have anybody download it off my website. It's free of charge. It's soup to nuts, everything about lending, almost half the stuff we covered tonight. So it'll take a lot of the Q&A out you probably had, maybe some you didn't have, but I'll send that to you.
Perfect. All right. That's awesome. We're going to post that on there as well. And guys, as always, Club 500 is and always it will be free. You guys are always going to be able to participate in these calls, and hopefully we can create a lot of value for you by bringing some great guests like Graham and add value to everybody every month.
Awesome. Thank you, guys. Thank you,
Thank
Peter.
you, guys.
Thanks for your time, Graham.
Thanks, Graham.
Thanks, Graham. Bye.